And yet in the first month of 2023, we've seen the opposite. We've seen a lot of investor enthusiasm for buying stocks and bonds and even some of the other alternative asset classes.
I'd like to welcome you to episode 14 of Barnes Quarterly here at Barnes Capital Group. We hope you had a good holiday season and end to your year and are off to a fast and successful start in 2023. From an investing standpoint, 2022 had a couple of major themes. One, probably the most important being inflation and the possibility of recession. Obviously, from an international standpoint, Russia's invasion of the Ukraine and its geopolitical effects on the rest of the world were another focus when we think about investing overseas. And then finally, toward the end of the year, midterms we had in our government ended up really not having that much of an impact on markets. But here we are in a new year, and we really wanted to focus this episode on what to look for in 2023 and what those major themes would be. And we're going to obviously be having Chris Zaccarelli, our Chief Investment Officer, as our guest. He continues to appear on several national media programs with his prognostications about the markets and observations on what may impact us in the coming year. We did close down last year, the end of the year, the S&P was off approximately 18%. The Barclays aggregate, which is the benchmark for bonds, was down 13%, and that's somewhat unique that you have bonds and stocks moving in a negative direction together. Usually one sort of balances out the other, but that was not the case last year. So Chris is going to give us some words of wisdom on what he's doing with portfolios from a strategic standpoint. So we will lead off with that. Chris, for the first time that I can remember, I obviously try and read what other managers are saying about their prognostications for the year ahead. And in a number of cases, nobody was committing one way or the other. They were saying, well, here are the three scenarios that we could have this year. If this happens, then that happens. If this happens, then that happens. Well, it was worthwhile to hear their opinions on that. But based on that, how do I invest? Because you've laid out three different possible scenarios. We did hear LPL's chief economist, Jeff Roach, was here at the Economics Club here a couple of weeks ago, and it was kind of refreshing to hear him actually state an opinion in terms of where he thought the market was going to go. He was calling for a recession in the first half of the year and a rally in the second half of the year, which would be great if that's how things play out. But what is an investor to do based on all this flood of information and variance of opinions looking at this year ahead?
So at least from an investment point of view, I think the more things are cloudy and the more you don't know where things are going to go, because there's a lot of policy uncertainty out there. It's unclear how far down inflation is going to go. It's unclear how far the Fed is going to have to go to fight inflation. And so if you're being completely honest with the situation and you have less certainty than normal in terms of a lot of outcomes that could go either way, that's where I think you have to go back to diversification. So, just like an athlete needs to be a little bit more, on their toes and ready to move in either direction when they're not sure how the play is unfolding, I think you have to do the same thing with the portfolio. So I think when you have a greater greater insight into where things are heading, you can either be a little bit more offensive or more defensive with your portfolio, and you can make adjustments in stocks and bonds accordingly. I think in this case, you have to be a little bit more well-rounded. You have to be a little bit more better positioned, with the exception of certain things that have gotten beaten up. So one thing that's good about cheap prices is that if bad things happen, a lot of that's already priced in. However, if things are not as bad as expected or things actually turn out better than expected, then you can go up. And so there are opportunities, and I'm thinking specifically of, smaller company stocks or thinking of some international stocks. I don't think it's safe to just go around the world anywhere, but I do think if you look at some of the larger franchises in Europe, and look at some of the bigger players in emerging markets, to the extent that they've sold off so much, you have a better risk reward opportunity. Doesn't mean that things can't keep going lower, but the more that they've sold off, the more you're likely to have gotten closer to the bottom. And so I think things are more attractive from that point of view. So those are some examples of things you can do actively in the portfolio in terms of giving a little bit of extra weight to certain areas of the market that have disproportionately been sold off. But I think in general, outside of those types of areas, I would try to be a little bit more well-rounded, or in portfolio speak, be a little better diversified than normal, and not necessarily overly concentrated in one particular area or another, as you would be if you had a little bit more conviction into where things were headed.
What about active versus passive and growth versus value?
So, active versus passive is the kind of debate that I think you're always going to have regardless of where you are in the cycle. From my point of view, and this is my opinion, active can be very helpful when you're at turning points. So to the extent that you think things are a little bit more risky than the overall average market, or you think things are a little bit better positioned than the overall market, I think active can do a better job. I think people would say that the more esoteric or niche the area is that you're working in, the more an active manager would have an opportunity to outperform. So again, if you were in small cap stocks or you were in emerging market stocks, areas where the broader index maybe is covering both profitable and unprofitable companies, an active manager probably has a better opportunity of seeing, or at least the opportunity of getting more profitable companies or excluding unprofitable companies from your portfolio. And so I think there's always room for active management to be superior, but I think people would say that the less specific you're talking about in terms of the types of investments, the more an index could outperform. Whereas if you have a more specific area, I think you really can see some expertise make a difference. But again, that's my opinion. As far as growth versus value, I think when you look at the kind of companies that are rapidly growing earnings, but you have to pay a high multiple on those earnings, that typically will work better when the economy is expanding and when the money supply is increasing. All things being equal, investors seem to put more of a value on opportunities to really grow earnings. If you're heading into a recession or you're heading into a slowdown, you may want to seek out companies that are not as expensive. And an example of that was last year. So last year, when people were worried about growth and worried about the economy potentially falling into recession, you saw very high PE multiple stocks, very expensive growth stocks really fall out of favor. And those companies that were priced a little bit less expensively, let's call it lower price to book or lower price to earning stocks, those value stocks outperform. And so I think that environment is likely to persist, where I think value will likely outperform, at least in the short run, but only because there's been a little bit of a deflating of the bubble in terms of the monetary base and in terms of the Fed raising interest rates and taking a little bit of froth out of the markets.
Okay. So kind of a recurring question that I always try and ask you is a couple of different scenarios. One, I've got an investor who has had a cash windfall and wants to begin investing in the markets. How do you do that? Or I am already in the markets, I'm a seasoned investor. How are you repositioning the portfolio?
So as far as an investor that has a windfall and has new money to put to work, in general, I typically would advocate for doing dollar cost averaging, where you put a little bit of money into the market over time, unless you're at a high extreme where the market is historically very, very overvalued, in which case I would either wait for a better opportunity or at the very most put very little money into the market. Or the converse, if you see markets very oversold and you're seeing valuations, in the low 10% or the 10th percentile or lower historical average, then I might be more inclined to put all of the money into the market. But in between those two scenarios where you're very overvalued, at least by historical metrics, or very undervalued by historical metrics, it's typically the most prudent way to go, I think, is to dollar cost average, put a little bit of money into the market. And I think we're in one of those cases right now. I don't think the market is historically overvalued, but the market is definitely not very inexpensive by historical standards. So I would say, given that windfall, I would put money to work slowly over time, get into a regular investment program, and that will help prevent you from missing a rally if one has already started. But that will also help prevent you from putting your money at the top if we're about to have a big drop in the markets. As far as for a person who's already in the markets, that's a little bit different. I think if you're already invested, it doesn't make sense to necessarily take big bets with either going all to cash or getting a lot more aggressive. I think what you want to do is continue to rebalance, use the portfolio allocation that we're using for this environment, as I mentioned earlier, being broadly diversified, potentially overweighting some areas of the market that had been sold off more than others, such as small cap stocks or some international stocks. That's where we're starting to position our portfolios. But in general, I'd say we're trying to be cautiously optimistic. We don't want to act as if the sky is falling and that terrible days are ahead. But on the other hand, I don't think that we've got the all clear. I don't know that all of the issues that we were dealing with last year, whether that's inflation, whether that's the Federal Reserve raising interest rates to much higher than normal levels, or even the possibility of recession, I don't know that any of those issues have completely gone away. But what has happened is the Fed has raised interest rates very high in a short period of time. And so I think they're unlikely to continue at that prior pace. And if anything, they're probably closer to stopping and pausing their interest rate hikes than they are to aggressively increasing them. Likewise, at least the economic data that we've seen so far is that a recession that seemed like it was going to happen much more quickly. So even as early as last year, it looked much more likely that we're going to have a recession early this year. Now it's possible that if we have a recession, it may be later in the year or possibly even pushed off into next year. No one really knows when a recession is going to happen, and it's very difficult to immediately identify a recession in real time. But if we look back in history, typically you'll start to see the unemployment rate go up at least a little bit, if not on a meaningful level. That's typically a really good sign that we are in a recession or about to enter a recession. And right now we've seen the opposite. The unemployment rate has continued to come lower. So it could be one of two things. Either the economy is stronger than we think and the recession is being pushed off for a longer period of time, or it could be that if the Fed is satisfied that inflation is continuing to come back down, and this is a big if because I'm not even sure if I agree with that, but if the Fed is satisfied that inflation will continue coming back down to their 2% target, they may be pretty much done with everything they need to do in terms of raising interest rates. And if it turns out that the economy is able to withstand this higher level of interest rates, another big if, then we may not necessarily have a recession. So I'm not willing to bet on the fact that we won't have a recession, but I think the data over even the last couple of months have been very positive, both in terms of unemployment staying low and inflation continuing to come back down. That would be the best case scenario where we would neither go into recession nor need to raise interest rates aggressively in order to fight inflation because what's already been done is taking effect. So again, it's not my view that the Fed's job is done, but I think a lot of people have been pleasantly surprised by what they've seen so far. So it's increasing the possibility that we may have a more mild recession or even possibly not have one at all in 2023. But it's very early times yet, and we'll have to see a lot more data before we can be sure that is the case.
You have talked a little bit about interest rate changes or what the Fed might be planning to do with interest rates. It seems like through some of the different people that we've talked with that they're kind of expecting a couple, 2 or 3 more rate hikes, and then they might sit and watch for a while and see what's happening with inflation. It looks like we're kind of nearing over the next year and a half, a tipping point or a pausing point with changes in interest rates. How are you positioning your fixed income portfolios now that we've kind of come through a cycle where we're hiking aggressively and maybe kind of topping off and eventually coming back down?
So as far as the bond market is concerned, given the fact that the Fed has been raising interest rates so dramatically, part of what we did was try to keep the portfolio much shorter duration, which just means on average, the time that our bonds took to mature was shorter than normal. And what that does is, all things being equal, the shorter duration of your bond portfolio, the less you'll be impacted by higher interest rates. But the reverse is true. If we really believe that interest rates are going to come back down as quickly as they've gone up, then the right thing to do would be to go back to the types of bonds that we had used prior to this inflationary period. And so that would be longer duration bonds. I think the jury is still out on that. I definitely believe that the Fed is very close to stopping their interest rate hikes. So I do think they'll get at least 2 more interest rate hikes in this year. And it's possible they will do a third. But I do agree with the many people who have said once the Fed is done raising interest rates, they're likely to pause and keep them at that level for a longer period of time. What I disagree with a lot of people saying is that after the Fed is done raising interest rates, they'll quickly start cutting them again. And so there's a pretty big divergence in opinion, whether you look at JP Morgan and some of those other banks, which are calling for rate cuts very quickly and happening this year, or you look at someone like a Morgan Stanley who is looking for interest rates to stay high for the duration of the year. I'm more firmly in the latter camp. I do believe that once the Fed is done raising interest rates, and I do believe we are close to them raising interest rates, I think they're going to hold them at that level for the rest of 2023. So given that I think they're going to keep interest rates at these higher levels, I've been doing a little bit less with bonds and not trying to potentially position for much lower interest rates ahead. But on the other hand, I do think there is a little bit more room for bonds to recover. And so I am looking to see the bond part of the portfolio have some meaningful improvement this year. And so far in January, we've seen both stocks and bonds appreciate in price. In the case of bonds, that means lower long-term yields. But I do believe that we're going to continue to see high short-term yields and potentially lower long-term yields, which is an unusual scenario, something that is called an inverted yield curve, because typically you'll see shorter duration, lower yields, and you'll see longer duration, higher yields. We've been seeing the opposite. And so what's interesting about this unusual situation of an inverted yield curve is it very typically signals a recession. So on the one hand, you're seeing the bond market flash very strong signals that it believes a recession is likely sometime in the next 12 to 18 months, because that's typically the time frame from between when an inverted yield curve starts to when a recession starts. But history doesn't necessarily have to be the guide for what happens this time around. There's a lot of unprecedented things that have happened, whether it's the once in a 100-year pandemic, which caused governments around the world to shut down commerce and businesses, which is something I believe has probably never happened to the extent that it happened in 2020. In addition to the Federal Reserve, which put trillions of dollars into the financial system, which I'm confident has never been done before in the history of the world. Even during the financial crisis between 2007 and 2009, even though the Federal Reserve did something similar to what they did in 2020, the magnitude of what they did in 2020 is much, much larger, 3 to 4 times as much as what they did during the financial crisis. So we have a lot of unprecedented types of events happening. And for that reason, I think you can look to history as a guide for what may happen in the future. But I don't know that you can necessarily take the patterns of the past and be confident that what has happened in the past will necessarily happen in the future.
Okay. Well, just sort of in summation, I guess, if you could just sort of distill what's going on right now, first part of the year, with what you know, what would the 3 major themes for 2023 be for investors to look out for?
So, given what we've seen so far in January in terms of a very strong stock market and a very strong bond market, both probably better than expected, I would say the 3 themes you really want to look at for this year are, one, is the Federal Reserve content with the amount of rate hikes that they've put into the economy? And so, will the Fed go much higher than people expect or keep rates for higher than people expect? So the Federal Reserve is the first theme. The second theme is going to be the economy in terms of, do we go into a recession in 2023, or does that get put off until a later date? And then the third theme is going to be investor risk tolerance. And so we've seen a really marked shift between investors being very pessimistic and very concerned, even as of the end of 2022. And yet in the first month of 2023, we've seen the opposite. We've seen a lot of investor enthusiasm for buying stocks and bonds, and even some of the other alternative asset classes. And so it'll be very important to watch and to see if that risk tolerance and that type of investment behavior persists for all of 2023, or if it's something that's more concentrated in the beginning of the year and then peters out eventually. So I'd say those are the three themes for 2023 that I'll be watching.
Very good. Well, as always, appreciate your time and hope your year's off to a good start, and we will be in touch.
That sounds great. It's always good talking with you, and I appreciate all the questions, and I'm looking forward to a productive year in 2023, and I hope it's the same for you and all your clients.
Thank you very much.
Thanks, Chris.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.